If you're serious about building long-term wealth through property, today's episode is one you cannot afford to miss.
You need to invest your super fund for your age and where you're at that time. You don't necessarily want to be buying something that's just ripping cash flow in the middle of Broken Hill, because you may miss out on the bigger portion, which is growth. If you're older, you may not want to focus on capital growth properties. You may want to focus on properties that give you cash flow, because as you head into pension phase and you need to draw down, you can't eat paper. You can't eat a balance sheet. You need to make sure that you've got that golden goose that's laying the egg to meet your pension phase requirements, which is a certain drawdown of the members' balance each year.
I'm joined by Jeremy Iannuzzelli, one of Australia's leading property accountants, the guy who sees behind the curtains of thousands of investors' portfolios every year, from first-time investors to those holding millions of dollars worth of assets.
One of the biggest things that people need to understand, that when you are selecting the assets inside super, you really need to be cognizant of what's going to go on later on, how you're going to fund pension, and if you do convert it to pension. So these are all things you chat with your accountant, your buyer's agent, financial planners, lenders. You just really got to have everyone working in kind of unison.
In this conversation, we dig into the government's new 5% deposit scheme and what it really means for investors, why more Australians are shifting money into self-managed super funds and using them to buy property, the looming risks of unrealised taxes, inheritance tax, and trust distribution changes, and how to structure your portfolio to stay ahead, plus the biggest mistakes Jeremy sees investors make and how the smartest ones pivot their strategy as they grow. If you're wondering how to protect and scale your portfolio in today's shifting tax and lending environment, Jeremy's insights will give you the clarity you need. Let's welcome Jeremy, everyone. Cheers. Today we've got one of my good friends, Jeremy Iannuzzelli. He's also my personal accountant and accountant to many buyers agents, and probably known as the best property accountant in Australia. Thanks for coming on, mate.
Mate, appreciate it, and excited. I've got a lovely Kiwi next to me today.
Got my dog next to you as well.
So excited to talk about all things property. A lot of things are changing in the environment and the market as well. We've got 5% deposit scheme coming through and been fast tracked to October, and what's that look like? And we've got caps coming on board and unrealised taxes in super. We've got talks around taxing of trust distributions. And more importantly, what other taxes will come into play, such as inheritance tax or tax on your own home. So we're going through such a very weird time, with legislation around taxing, market movements, and also interest rates as well. We've had a couple of interest rate decreases. So lots of things happening, and ready to unpack it with you today.
Lots of talk. So you've been on the podcast before, but do you maybe just give you a little spiel about who you are, what you've done, your company, all that type of stuff?
So I've been in the industry now for nearly 20 years as an accountant. Love doing what I do. I'm a property investor myself, owning quite a large portfolio of properties, an array of residential and commercial, and get to enjoy, many people like yourself, buyers agents who are clients of mine, and getting to see where they're buying, and managing also, thousands of property investors across the country, and lucky enough to see probably 9,000 to 10,000 properties a year across my clients' portfolio. So it's in the billions, and I get paid to learn every day. So I'm very excited. That's what I get to teach myself, and also our colleagues as well. They're all very skilled accountants and skilled property investors.
You've got one of those fun jobs. I'd say like a buyer's agent is probably similar, where we get to ask everything and they tell us everything. Like you see the actual real numbers. I get the fluffed up version. This is what I earn. This is where I'm going. This is how I've made my money. You actually see the actual nuts and bolts of it and what they're buying outside of it as well.
And people from different walks of life, people that are worth hundreds of millions of dollars to people that are just starting out, people that have, 50, 60 years of age to people that are 25. So I get an array of different journeys, different pivots that they've made at different times of their life. And I get to see what works, what doesn't. And, quite often I get to share with people about, a client of mine who sold his business, paid off his entire property portfolio worth $35 million, thought he could retire quite comfortably, and found out that land tax was about $600,000 a year, and his portfolio was only making him a couple $100,000. Now, $200,000 is still a lot of money. I don't discount that for many people, but for someone like him who was used to having a lot more and being able to do a lot more things, seeing him pivot away from, very traditional holding of investment properties to changing things up and becoming more sophisticated in his approach, that was an eye-opener for me. because it just got to show me that, hey, not just buying something for the sake of buying something will translate into profit. You actually need to be sophisticated and think about what assets you should be having at certain times of your life, whether you're young or old.
I think that's the main difference between a good property accountant and a bad one. So like a bad one will still do the tax, but I use you as a business mentor / property mentor as well, because anytime I'm thinking of like, oh, Jeremy, we're thinking about buying a principal place of residence, you come back being like, oh, cool, you need to be earning X, Y, Z. This is the negative to that scenario, where you don't get that from just an off-the-shelf accountant.
Yeah, I mean, you've got to always have an X factor. I think there's always got to be a point of differentiation. And, I believe accountants now are much more than just bean counters. We're along as a professional with your journey and giving you guidance. If we see something that has worked or hasn't, we've got to share that view with you. Not necessarily it's advice or financial advice, but just an opinion to something that may occur from what you've seen in the past.
Wasn't going to talk about this, but how is AI, do you think, going to change accounting? Is there going to be systems where people can generally work out the best tax structures, and then, like you said, accounting's probably going to be more of the leader in the space of directing people where to buy and how to buy? Yeah,
look, AI is shaking everything up. I think it's got a place in pretty much every industry. Initially started, what people don't remember, but initially started in the car manufacturing industry. You had thousands of people in a warehouse, and now you've got robots doing a large portion, a majority of building cars, and it's just naturally going to occur in every profession. But in accounting space, it's getting heavily used. The beauty of what we do, though, it's all about interpretation of legislation. Yeah. So AI will have its own interpretation to legislation, but there's also an element where you can think outside the square of a circumstance that may have a connection, but not necessarily directly related. So I think accountants over time will become more advisors, interpreting legislation, more importantly, giving that that real flavor of mentoring as opposed to just simple tax returns.
I think it's also just, like you mentioned, get rid of the bean counters and the data entry. That just disappears, and then it becomes more of a thought leader in the space.
Absolutely. I think, the biggest part of my role as an accountant is to be with you along your journey, share opinions, give you my war stories, things that have happened in the past, and then that will help you frame, what you do moving forward.
Yeah. All right, cool. So a lot of current affair topics we spoke about the first. The first one, I get asked about this every day, and I keep losing clients to it actually. People say, oh, I'm not going to buy commercial at the moment. I'm going to go buy residential because the first homeowner changes is going to give that a boost. Firstly, what are your thoughts? And I can give you my thoughts.
Look, governments had their hands in legislation to help prop certain sectors of the economy at every particular time. And what people also need to understand is, yes, for many people, a deposit is an issue of getting into a property, but you still need to be able to borrow the remaining 95%. The government's not giving you 15% for free. Yeah. There is a borrowing attached to it. There's an interest attached to it. It's just helping you eliminate lender's mortgage insurance, which in most cases is, could be $4,000 to $15,000, but also helping you get into the market with a lesser amount of deposit. Will we see it impact the property market from a residential perspective? Yes, but it'll probably be at the lower end. Mm-hmm. People who are buying $1.5 million properties aren't necessarily borrowing $1.4 million to do it. It's going to require a substantial amount of after-tax money to do it. It will impact the owner-occupied market as opposed to the investor-grade style of properties, because again, this is eligible for owner-occupiers, not for investors. Well,
this is my counter-argument to it when everyone's panicking about it. Is most markets we look at anyway, sometimes it's 70% investors, 30%. So you only got that 30% owner-occupiers. Of that 30%, they're not all first-time buyers. So I'm making up a number. Let's say it's 15%. So we're only actually shifting 15% of the market potentially.
Absolutely. And look, again, what we've mentioned before, it's borrowing capacity as well. You're still got to be able to borrow the remaining balance after giving you 5% deposit. So there will be a shift. Do I think it's actually going to be quite large? I don't think it's going to be astronomical. I don't think it's going to be large enough to materially change the numbers. But I do think it will help some markets. I do think it's going to help, obviously, a lot of Aussies get into their own homes. But the reality is we've still got a shortage of properties. Yeah. And with that shortage of properties, it's just going to create further demand, which means that, yes, prices will move to an extent. But how far have people got that they can overpay for something for the sake of getting into it?
It's still got to be affordable. That's the thing. And we had a chat off air about how this can affect the commercial market. And anytime there's money in residential, the money flows to the commercial because that's what services the people.
Absolutely.
Car mechanics, wholesalers, fabricators, storage, kitchen supplies, like all that flourishes as well.
Yeah, and one of the biggest benefactors of an example like that is the southeast region of Queensland. Again, we're talking about it off air, is that, that Gold Coast region has had the largest increase of population probably across any region of the country. People going there for the beautiful sun. And what's that done? It's created a significant shortage of commercial in the area. So there's lots of things that come from very strong residential markets, which then increase, obviously, commercial markets as well.
5 years ago, we were buying so much in Gold Coast. Now we barely buy anything. We can't get a hold of anything. The owner-occupied space for commercial is more demand than the investor space. So i.e., if you've got an industrial warehouse there, you get a premium for selling it without a tenant, which was the opposite 5 years ago. With a tenant, 20% premium. So now that's actually shifted as well, which is a good sign the economy's strong if all the business owners are willing to buy it.
Absolutely.
And cashed up.
Yeah.
And like you said, people are willing to move. Me and my partner Lisa, we did that analysis. We're looking at houses around Freshwater, Northern Beaches, and we're like, if we spend the same money, Gold Coast or Sunshine Coast, much better bang for buck, much better lifestyle, cost of living's better, and that's also bumped prices up as well.
Yeah, but I think the main thing for, again, everybody that's listening is don't let pandemonium creep in or that fear of missing out. It obviously does drive the market if we have FOMO in our minds. But yeah, there's a certain aspect you also need to understand. Being a homeowner or an investor is you still need to be able to afford the loan. Yeah. So there's only can grow to a certain extent.
It's one of those ones, you've done this longer than me, but I've been by zone close to 10 years now. There's always a story about why the market's going to go up and a story why the market's going to go down. Like 3 years ago, we were talking about how that's going to be a property bubble because interest rates are climbing and the bubble's going to burst. Now interest rates coming down a little bit and there's this first homeowners grant change and they're like, oh, the market's going to go up again. I'm just like, how is the rule changing every single year based on what it is? And we've had potential removal of negative gearing, changes in government, world wars.
Yeah, geopolitical issues, unrealized taxes on super.
There's always something. The funny one I get, people go, oh, interest rates are coming down, therefore the property market will grow. My counter argument to that is when interest rates were going up, the market was going up as well. So why is it a two-paced one where...
Yeah, then that's one of the big things people need to understand. Interest rates come down on the back of an economy suffering. Yeah. Now we haven't had any real suffering in the economy, although yes, some retail sectors haven't had a huge level of demand like they did during COVID when there was just so much money splashing around. But, you look at somewhere like New Zealand. New Zealand is a really good example of how an economy works off the back of interest rates. Their market was flourishing. Economy was booming during COVID. Their interest rates went much higher than ours. I think their New Zealand Reserve Bank rate was sitting around about mid-fives, although it's come down quite substantially now. They're a very advanced economy with a significant decline in their property market and their economy. Yeah. And there's a lot of pain at the moment in New Zealand, and they've got rates coming down, and property prices are probably coming down faster than rates. So people need to understand that rates going up is when economy's running too hot, things are doing too well, and we need to slow it down. Rates coming down is when the economy is suffering a bit. And Australia, I think, has done really well to have that soft landing. But, when rates are coming down, there's a bit of pain somewhere, and that's where they're trying to stimulate it. So governments do this all the time. They'll create lots of policy, lots of legislation to keep going. And in Australia, we're property mad. If we've got to keep property moving forward. If we don't, there's going to be a lot of people that will be out of work. So government's going to do whatever they can to keep the commercial and residential sector humming because it's creating a lot of jobs.
Well, what are your thoughts about the people that say they're sitting down the market? Because I always say, no, you buy when the money's there, when the banks will lend to you. It just changes the market you actually buy. You can't pick the market. But you've said that to me before in the past where you can see sometimes doom and gloom, you say, keep the cash, there's some bargains coming. But I've always had that opposite one of just no, you move to where you think the market is best at that time because I admit I can't pick the market. I can pick it to about 3 years. I can't pick it to 12 months.
Yeah, and it's incredibly hard. I always like to have a bit of buffer on the side to take on opportunities. I've bought a couple of properties on the back of people, going bust, liquidated, mortgagee repossession sales, and because I was able to move quick, I was able to have a substantial level of benefit that comes with it, cheaper prices, better quality property. But what I've learned over the years is that when you're borrowing today, you're using tomorrow's money to pay it off. Yeah. And tomorrow's money is going to be always more than what yesterday was. And best example I give to everybody is you speak to your parents 35 years ago, if they told you had a $50,000 loan, that's something that they probably would have been keeping one eye open at night. Yeah. Now you tell someone you've got a $50,000 loan on your own home, they'll tell you virtually paid your house off. Yeah. $50,000 hasn't changed. You put it in the ground 30 years ago, dig it up today, it's still 50 grand. But it's what you can do with that money that has changed, and that's called the deflation of currency. So, when you've got an opportunity where you can buy, no matter what market it's in, you obviously got to make sure the metrics are there and the data sets are correct, but you buy. You got to build that denominator up as high as you can, as long as you can, and hold it for as long as you can, and then have certain pivots in your life. I think those pivots are important, knowing what type of assets you need at any particular time to get you where you want to be, which is ultimately a healthy retirement.
Well, you're actually one of the ones when obviously bought a lot of like my cheaper properties, the Logans and the Western Sydneys and that, and then business started doing well, my portfolio is doing well. You were the one person who was actually like, it's time to stop buying those cheaper assets. You need to focus on higher cash flow and larger assets, because there's no point having 20 plus cheap properties that aren't doing the right thing for you. Which is rare, because most people and most of the buyers agents as well, like, oh, it's all about, let's get 20, 30 properties. And you hear them all say like, oh, I've got a 50 properties, I've got 100. They're talking about $100,000, $200,000 assets. It's not necessarily helping them get to the next step.
Absolutely. And one of the best examples I give to person is that kitchens and roofs don't discriminate what area you're in. Yeah. You know, a roof in regional, part of Australia is still going to cost you the same as the eastern suburbs of Sydney. Yeah. BHP don't just add extra cost onto the Colorbond steel because you're from Bondi compared to, say, Broken Hill. So once you factor those in, repairs and maintenance of those cheaper priced properties sometimes can make up 30, 40, 50% of the value of the property compared to somewhere nicer, or a good commercial or good residential property in metropolitan areas where it might be only 2 or 3% of the value.
Well, you saw that in my portfolio when I had like the $30,000 Cairns unit and the $100,000 Foster townhouse and things like that. The maintenance would just like, I spent $12,000 on a $110,000 townhouse. What was the point? That $12,000 would have done the exact same thing on a $500,000, $600,000 house.
Absolutely. So little things like that make a change, but not to say that you don't buy cheap properties. There are sometimes some really good bargains out there for people. It's just not something that you do for the rest of your investment journey. I always say to people, as we get older, we earn more money, we upgrade our car. My first car was a 1989 N13, broken down, panel falling off, red Nissan Pulsar. And then, as I started to earn more money, I upgraded my car, and that's what I like to do with my portfolio. As I earned more and became more sophisticated, I wanted to upgrade the portfolio. And now, every asset that I'm buying, there's a business plan attached to it. There's an exit strategy. There's an X factor. There's something you can do to improve the value.
I want to touch on that because you always say that it's a business plan when you buy a property, which most people don't say that. They say it's a property plan, but you treat it like a business. You look at return on investment, how are you going to pay it off, what's the purpose of that vehicle for the next 5-10 years, which is the right way of doing it. But we're talking about upgrading the value of the properties, but it's also you're changing the priorities of the property. So with me, like sold off most of my residential to buy cash generating ones because I'm not the type of person who cares about big net wealth. Yes, I could probably leverage up, and the banks told me the other day I could borrow 12.5 mil extra. I'm not doing that because it's not going to suit my strategy.
Yeah, and one of the things I remember you and we debated quite vigorously about, I said to you, you're seeing some of these great deals come through. Buy some of those ones where you can add a substantial amount of value to and change it and flip it. And, you decided to buy the shopping centre, which has done very well, mind you. A bit more passive in nature. You've taken a bit of a sacrifice potentially on yield, but it's giving you a headache-free income. Yeah. So you've also got to factor those things in, what you want from your portfolio. So if you want to be very active, go out there and go buy the industrial and add that mezzanine on and add value and do all those things. Or if you want to be passive, there's still so much value there that you can achieve by buying the right asset.
One of the traps I see, and we get this with almost every client, they say they want freestanding, value add, under market rent. And then they do exist sometimes, but I can let you know, like when you buy them, 99% of the time you don't actually do that stuff anyway, because what happens is if your tenant's happy and they don't move, why would you do it?
Absolutely.
Like you're not going to knock down the freestanding place to build another one if your tenant's there. And that's the trap. And yes, they'll say, in 20 years time, I can then do it. But you've paid a premium for that. It's the same as when you get people that buy a house and they go, instead of 600 square meters, I'm going to buy 1,200 square meters of land. They pay an extra 300 grand for that. They don't do anything with it. That 300 grand might have been better spent buying another house, which is another income generating asset.
Yeah, small actionable items. I think sometimes when you try to have everything in, you get a bellyache. Yeah. Just small actionable items, and just try to have that business plan attached to what you're doing and execute it really well.
Yeah, that's a good way of saying it. So next top topic we were speaking about, self-managed super funds.
Yes.
Let's maybe start off general. So let's just go self-managed super funds, why commercial property might make sense in a self-managed super fund, and then we can go on to the new legislation changes.
Well, I'm gonna start off with a very controversial statement and what's happening. So at the moment, just being an accountant and chatting with lots of people in the industry, financial planners and people in the know, at the moment there's actually a net negative decrease in the amount of new entrants coming into industry funds, and there's a net negative outflow of actually money leaving industry super. So for anyone out there, what that means is that there is a flow of money coming out of people like CBUS and Host and AusSuper. And you're seeing, ASIC at the moment, Australian Securities Investment Commission, they're taking some of these major super funds to court and breaching them and fining them because they're slow on death benefit payments, slow on releases. There's a big shift at the moment. A lot of people are starting to wake up a little bit and say, well, I can take control of my money in super. I can invest in property. I can maybe buy cryptocurrency. I can buy shares. I want to have a little bit more autonomy with what I do. So I've probably never seen more self-managed super funds being established in the industry than ever before.
Anecdotally, probably about 1 in 4 of our commercial purchases are self-managed super funds.
Yeah, it's huge.
It used to be probably 1 in 8, 1 in 10.
Huge.
And that's been a big shift in the last 3 years.
And that has contributed to a rise in property market as well. Don't mistaken why our property market's increasing. It's access to capital, access to lending. You take capital away, you take lending away, you haven't got a property market. Yeah. So super funds is giving people a door to open to be able to continue to buy, whether it's residential or commercial or other assets, shares and cryptocurrencies, fine art, all the stuff that comes with it, as long as it's for the benefit of the members for their retirement. Big disclaimer. So to get that out there. But yeah, a lot of people are utilising their super, having healthy balances of $250,000, $300,000, and they're able then to borrow to buy good quality assets. One of the big things that, I suggest with clients is there's some good tax benefits involved with super. Again, 15% contributions for most people going in, great. And 10% tax rates if you're selling assets that you've held longer than 12 months. Yeah. So exit costs are a little bit lesser in super compared to being outside super. And getting that strategy right, and that's probably one of the biggest things I say to everybody, is you need to invest your super fund for, your age and where you're at that time. You don't necessarily want to be buying something that's just ripping cash flow in the middle of Broken Hill. Yeah. Because you may miss out on the bigger portion, which is growth. Again, if you're older, you may not want to focus on capital growth properties. You may want to focus on properties that give you cash flow. Because as you head into pension phase and you need to draw down, and we were talking about this before, capital growth, you can't eat paper. Yeah. You can't eat a balance sheet. You need to make sure that you've got that golden goose that's laying the egg to meet your pension phase requirements, which is a certain drawdown of the members' balance each year. Yeah. And in most cases, and I say this all the time, residential property for me, I look at it as a growth asset. Yeah. Really good for, really short, sharp growth if you're getting the data sets right. And say commercial property is really good from a cash flow perspective. Although, and I do want to debate this, and I'll ask you the question as well, I've done a bit of a chart on residential versus commercial over 20 years. Mm-hmm. They both get to the same place at the same time. Yep. But the difference is commercial have this nice, beautiful, like I call it a step, just a nice, beautiful step or staircase going up, where residential has this spikes, 3 years of just absolute ballooning, comes down a bit, stagnates, and then has another 3 years of ballooning and then continues to follow the pattern. Yeah. Is it something you've seen as well?
It is. It's funny. CoreLogic and ABS released a chart about 2 weeks ago showing the best performing assets in all of Australia in the last 20 years. Funnily enough, the winner by far, it was 265% growth, was Sydney Industrial. Yeah, wow. And then the rest of them, all industrial and all capital cities, were all around the 180 to 200% mark. So on par, they're all within 10% of each other, which goes to show that whole argument of you don't get capital growth from commercial is just completely false. But that's not even taking into account you're getting 3 times the cash flow from commercial. So arguably the ROI is actually better by buying commercial. But as you mentioned, more steps to fall down on if you make a mistake. You go buy a high risk one in Mackay and it sits vacant for 3 years. I don't care what the capital growth is over 20 years. If you can't handle that, then it's not worth buying. Yeah,
you got to factor all that stuff in, and that's why buffers are also important for commercial property investing and residential as well. Yeah. But super, coming back to what the original question was, it's astonishing just to see how many super funds are out there now and how much volume in the market.
Are you seeing people buy more commercial, more resi and self-managed super funds now, or a bit of both?
The younger people definitely buying more residential properties in self-managed super. The people say with 250, 300 grand. There's some interesting lenders out there now. I got told by a broker that Granite's done 90% lending with LMI, of course, 90% lending for self-managed super funds, which I remember when I got told that, I said, are you sure? sure because I've never seen that before.
Doing
ever.
80% for commercial.
Just unbelievable. Unbelievable. I've never seen that before. But, going onto their website and fact checking, I was like, wow, that is. So that's going to give more access to more people to be able to borrow, potentially with lesser balances as well, although, not recommended. Make sure it's healthy. But I'm seeing more younger people definitely move into the residential sector. Again, easier access, less capital intensive. But those mid-40s to late 40s, more people are buying more commercial investments. They're comfortable where things are. They know their contributions are healthy.
They've also got a healthy portfolio outside. Most of our clients are buying self-managed super fund, like you said, club 40 to 50, got 2 or 3 or 4 residential properties. And they're like, cool, this is a nice little diversification to get into it. I argue that commercial makes more sense for me in self-managed super fund, but maybe let's strip it back. Let's go. What are the tax benefits? If I go out and buy $1 million industrial property in my self-managed super fund, why is that better than buying outside my self-managed super fund?
Well, super fund has a 15% tax rate on earnings. So number one, you're getting a tax rate which is equivalent to that of like a Singapore. So that's fantastic. A lot of people's thoughts and mindset is, well, I don't want to pay too much tax. Well, super is a great way to do it. Even with the 1.9, maybe $2 million index cap of pension phase that you can convert, which again, complexity is involved, but anyone out there, you can have about $2 million under pension phase tax-free. Everything above that is prorated. Even with the Division 296 tax, the unrealized tax on super at $3 million, still it makes sense to have lots of investment in super.
And putting your income into super as well, because there's another tax saving.
Absolutely. You get a tax benefit in your own name. So it could be at 30, 40 or 47%. And super fund only pays tax at 15. So there's a substantial amount of return you're generating guaranteed through the tax savings.
That's the word you always say to me. It's guaranteed. It's like, if you could get a share that guaranteed you this return, would you take it? And that's how I look at it now.
You're moving money from left to right, getting a guaranteed return through the tax benefit, but it needs to be invested after that to ensure that return only increases. But significant tax benefits, 15% on earnings, 10% on capital gains. You're not going to beat it. Superannuation is designed to give us healthy retirements and incentives throughout. So that's number one. Number two, and this is probably where I'd say the other side of the equation of buying a $1 million property commercial in super, is making sure that you are going to meet all the requirements when it does convert to pension phase. Coming back to a comment I said before, so many people are holding properties towards retirement that will not give them the cash flow to be able to meet their minimum pension drawdown. That means
Don't explain that means it.
So minimum pension drawdown is arguably 4 or 4.5%. The number escapes me, but let's call it 4%. When you convert your super fund to pension phase, you must draw down 4% of your members' balance. So if you've got a $1 million members fund, you must draw down $40,000 a year in actual pension withdrawal. Now, if you've got a $1 million residential property that's only rented for, say, $50,000 a year, you've got council rates, water rates, insurances, all the other stuff that comes with it, and you need to draw down $40,000, you're not going to be able to meet that requirement. Which means you're going to have to either sell some assets with inside the fund, and if it's all sitting with inside one property, you're shot. You're not going to be compliant. You're going to have all these contraventions. So with a $1 million, say, commercial property where the net yield might be 4.5% net yield, that's where you will be able to meet your minimum pension withdrawal of $40,000, be compliant, and then continue to have your asset growing and inflating by the lease and inflating by the value each year.
I think the point as well is, if you bought $1 million asset and say you've got a 20-year horizon, and like we buy around the 5-6% net yield now, at that point, it's not going to be a 5-6% net yield as well. It's going to be, let's just say, a 12% yield. So that kind of 4%. Okay, then think, but they're valuing the property's value, aren't they, to get that 4%?
Absolutely.
So that's also in turn with it.
Increasing as well. But that's where you kind of have that correlation between the asset value and the net yield, where you not necessarily will have that correlation in the residential market. You could have, the asset value move from 1 million to 3 million in the space of 3 years.
If you're out of cycle, like we've seen what's happened with the rents last year, then it stagnates for 5 years. If you're in that stagnation phase, a lot harder to pay it off.
Absolutely. So that's one of the biggest things that people need to understand understand that when you are selecting the assets inside super, you really need to be cognizant of what's going to go on later on, how are you going to fund pension, and if you do convert it to pension. So these are all things you chat with your accountant, your buyer's agent, financial planners, lenders. You just really got to have everyone working in kind of unison.
So without giving financial advice, what are you generally recommending for that? Is it just diversifying your funds and not putting all your eggs just into one property?
Yeah, it is. But also we spoke about the pivot. The pivot's very important. You need to understand, again, what is your requirement from an income perspective when you do convert your super fund to pension phase. I've got a balance of X. I need to make sure I can draw down Y. You need to ensure that the assets within inside the fund allow you to draw down the Y, which is the amount each year. I just see so many people getting trapped because they're holding on to assets which are, again, great balance sheet assets, but they're not the right assets that they should be holding at pension phase in their super. So it's important to make sure that you're getting that right. And if you leave it too long, you might be forced to sell something as opposed to being able to keep it longer term to have not only growth, but again, that golden goose giving you the golden egg every year.
So just to explain it clearly, because obviously the income that you get from the asset is tax-free under 200K.
Under pension phase.
Under pension phase.
Yep.
So that's tax-free money, but then you've still got that 4% that you've got to draw out of it somehow.
Correct. Yep. Based upon the members balance. So again, really good example again, $1 million members balance, and that's call it arguably the value of the property. They've only got one property, very little cash, $1 million. You've got to have $40,000 as a drawdown each year. That means that the asset needs to provide $40,000 worth of income after expenses. That's after, accounting fees and bank fees and all those things. It needs to have a net income of $40,000. If it does not, then you can't meet your minimum withdrawal, and then all of a sudden you start to contravene your fund. So important, right assets, right time. If you are investing in super, still love super. Again, really good tax incentives and a really good way to grow your wealth in an environment which is conducive for it.
Is there not a service that would bankroll that of you've got $1 million asset, we're happy to bankroll you the $40,000 a year, but we own that part of it until you pay us back?
Not in super. So outside super, you can have your, what do they call it? Reverse mortgages. But in super, you can't extract equity. So when you pay your property off, or you have taken out a loan for a property that's grown in value, you've got to sell it.
Not extracting it. I was just more thinking almost like an insurance policy of someone being like, yeah, we'll give you that $40,000 a year, but we're owning title of that until you pay it back. And obviously they charge, they'll give you the $40,000, but you actually owe them $50,000 per year.
Yeah, good. Look, if they change the SIS Act, it'd be great if they could, but no, and there's no incentive like that within super. It's a very, very strict governed entity, which is governed by the SIS Act, which is the Superannuation Industry Act, as well as some very iron-tight legislation. Government wants you to have some really good tax incentives in super, but they don't want too much. They ideally want you to take it all out.
Well, they just don't want people ending with this huge nest egg that's just sitting there that they're not getting any money for. But they know if they force you to take it out, you're going to put it back into the economy because you're going to go buy your coffees and food and holidays and all the goods and services. Hoarding
wealth. That's one of the biggest things the government now are trying to stop. They don't want people hoarding wealth.
My partner's from the UK. They got the death tax. They really come after you. So everyone over there gives their assets away to their kids and basically offloads it.
Yeah, and I've heard farms. A lot of people buy farms because if you have an active producing farm in the UK, it helps to avoid the inheritance or death tax.
They take 50%, I believe. So it's 50% of what you're worth. They'll take it. So that's why it's better off just to give it to your kids, get it out, and basically die broke.
Yeah, well, it's going to happen. I truly believe it's going to happen. Again, the way the government works, and it's not going to happen today, but it's something that they'll do over time. It's a test. They've introduced the cap on the pension phase, which came in a couple of years ago. They've brought in Division 296 tax. There's more talk and rhetoric around taxing of trust distributions. But there is so much wealth in Australia locked up in people's principal place of residence. There are people inheriting, $10, $15, $20 million portfolios that the government's not getting a piece until those properties are sold. Because when you pass away and your children inherit your assets, they inherit your cost base. So tax will be paid when they sell the property. Now, if they don't sell,
just keep passing it on.
Just keep passing on, and dynasties are built and wealth continues to grow, and the government's got all this contingent tax that they want to collect, but they can't touch yet. So I do think there will be an inheritance tax that comes in over time. And if they want to, and they'll try to, maybe look at taxing our principal place of residence, because in the end, we've got a government which did release in their last budget 10 years of forecasted deficits.
Yeah.
That's huge. You've got a business that you're seeing that's going to lose money for the next 10 years. You either, for me, I'd be telling the client, get out or shut it down. So the government's got a problem, and property investors always seem like the easiest way to collect the dollars.
That's probably a good segue. So what's the recent changes for super funds with commercial?
Yeah, so from Division 296, this tax on unrealised gains, they're creating this $3 million cap. And they're saying, well, we're essentially going to tax the value movement of your assets above that $3 million cap. So what that means is if you've got properties, again, that's arguably residential properties, which may be more growth orientated, not so much income orientated, there'll be a point in time where the tax on the unrealised gains of your asset will be more than the actual income that the asset's providing. So again, it comes back to the asset selection. You need to have an asset where the growth and the income that it's providing are very much correlated.
Yep.
If they're not, you're going to have a very big swing in either direction, and it's going to be very tough for you and all your professionals around you to be able to make sure that you've got a healthy and sustainable portfolio for the long term, which is giving you an income that you need to have a healthy and fun retirement.
So what are the ramifications of that? You think less people will invest in that, or it's a blinkers on for most people and they're just buying, they don't actually look at that?
It's a very small amount of people. They're talking about 80,000 people that it's going to impact. So very small at the moment. But I've said in one of my podcasts in the past, I've said 80,000 will become 250, 250 will become 1 million, 1 million will become 5 million very quickly, because as asset values grow and people's incomes increase, super becomes a big part of their investment journey. A lot of super funds are going to hit those caps.
Yeah.
So it's something to consider, but your asset selection becomes key. Your vision around having, balance sheet orientated assets versus cash flow orientated assets becomes more prevalent, and you want to be making sure that you're not trapped in this Division 296, cycle.
Do you just want to explain Division 296, Claire?
Yep, that's the unrealised tax for people that have a balance over 3 mil. If you're trapped in that cycle where you've got assets that are continuing to grow by market value and it's just year on year growth, and again, that correlation of the income, as I mentioned before, is not there, you're going to have more tax that you're paying on money you haven't received. And that's my gripe with the unrealised tax. They're making you pay something as a tax on an income or a value that you actually haven't realised yet. You haven't sold the property hasn't earned that much income, and that's where potentially the unrealised tax will be more than the actual income that the asset's generated. So it's a nasty one.
That is one of the tough ones. I remember I saw on Instagram, it was about Elon Musk's shares in Tesla, and he's like, I haven't sold them yet, I don't have to pay any tax. But then he uses those shares and he gives ownership to someone else in those shares, so he avoids the tax that way. It's effectively, he's trying to avoid that.
Yeah, absolutely. Or what these wealthy people do is they'll just take a loan against their shares. They'll never sell it. Hopefully the shares continue to grow. They just keep taking a loan against it. It's tax-free money.
Yeah. Okay.
We just haven't got, we've got mechanisms like that in Australia, but they're not as prevalent in Australia as compared to the US. US is just anything goes.
Actually, let's go into that. So what mechanisms do you see for tax in general that are good for commercial properties?
The structure of how you purchase a commercial property becomes very important. So ideally, you don't want to be buying a commercial property in your own name. Again, you've got to register for GST, you're owning the asset. Personally, you are in the business of letting out commercial space.
Do you ever recommend buying under a personal name? Because I get asked every day by clients, what do you think I should buy? And I always say, go talk to your accountant, because it's tax minimisation or asset protection. However, the one that's not spoken about probably more so is I actually say it's also a broker question. Because if you can borrow more money in a certain asset, I don't care what the tax things. If I can go get $1 million in a certain asset, certain structure, I don't care that I'm saving 5 or 10 grand in tax. That $1 million is way better off getting me to another $60,000 passive income.
Yeah, there's more lending protections when buying in your own name, in the sense that sometimes that might be an inhibitor for your growth.
So when would you say buy under a personal name? Looking at commercial property.
Yeah, not often, okay. Not regularly, not often. If commercial property, say for argument's sake, was commercial by nature but could have a zoning change to be residential,
okay. Yep.
Which there are some properties like that I've seen in Western Australia, commercial, but have an option where you can rezone it, change the use for residential, then maybe not a bad idea.
What about if it was a really low yielding one? If they had one something like Sydney and it was 2.5%, but even then, it's going to turn positive at some point.
It turned positive at some point, but it's the risk that comes with commercial property. People go, well, what's the risk? I'm just an investor. You're not. You're actually in business.
Yeah.
One of the worst things I've ever seen is, again, a freehold property in a rural place rented to a dump truck business that had skip bins and all those things. They went bust, and what did they leave on the property? Asbestos.
Yeah.
Lots of it. Now, you can't go back and sue the tenant because they don't exist anymore. They're liquidated. So, that particular cleanup cost actually went into the tens of millions of dollars. Because it was owned within inside a structure, it was able to be liquidated, and the client only had exposure what was in that structure. Where if it was in their own name, they would have lost their house and probably other things too.
Yeah, true.
So these are the little things that you need to be cognizant of as well, which is the right structure, the right type of property, and making sure that everything kind of fits in together. But generally speaking, trusts are what I encourage my clients to invest in.
When actually we'll do twofold. We'll first give us the benefits of buying under the trust, and then second, when would you not recommend a trust? When would you go something else?
Yep. So obviously benefits of a trust is you get that layer of asset protection when you accompany it with a corporate trustee. You get some really good tax minimization techniques, the ability of being able to distribute profits, also the ability to obtain a 50% discount, always a good one. And then some borrowing benefits. Again, lot of trust lending, commercial lending's outside NCCP, which is again a little bit of a consumer protection code. It gives you an opportunity of being able to continue to buy more and more properties and lend more and more. So again, you hear a lot of these very big, business tycoons that are buying $150, $200 million pubs. Their income's not $50 million a year.
Yeah.
They're in commercial lending. It's all about, does the bank back you? Are you meeting your interest coverage ratios, or otherwise known as ICR commitments? A lot of different things to kind of give you a loan to buy commercial property, not so much secured like it is under the normal mum and dad residential lending.
Well, the banks just want to see that it's a profit generating entity, don't they? So
they do.
Then some lenders don't even ask for an accountant's letter. Other ones will say, get your accountant to sign off.
And you've got lease doc loan products and low doc loan products and full doc loan products. There's a plethora of different products out there, and banks are kind of bullish on it. Not all the time, but kind of bullish on it. So it continues the spiral and the wheel turning. Right. When I would recommend other structures, again, coming back to how the person's earning their money. If they're pulling out large sums of money out of their company, for argument's sake, and they don't want to get any deed of loans, you might just want to do a company-to-company lending arrangement, and you might buy the commercial property in a business. You don't necessarily have any beneficiaries that you want to pass it through to. You might just want to keep it in a company, although it's not 100% recommended because companies don't receive a 50% discount, so the potential tax might be higher. People say, well, my tax rate in company will only be 25 or 30%. Not necessarily true.
Okay,
and why I say not necessarily true is that, again, when you sell a property in a trust, you distribute it to an individual, the maximum tax rate on the total gain that will be made will be 23.5%, which is 47% of half the profit. So anybody out there, when we get a 50% discount on a capital gain, if we make 100 grand, we get 50,000 of that in our back pocket. The other 50,000 gets added to our marginal tax rate or our income. Your income goes to the highest marginal tax rate of 47%. 47% on $50,000 equates to 23.5% on the total 100,000. So anybody doing the maths out there, when in a company, you pay tax in a company, it's actually called a franking credit. So that could be 30% tax. That means to get the money out of the company, you must pay a dividend. Now, that dividend has the franking credit attached to it, which is at 30 cents in the dollar. But if you want to get that dividend out all at the same time, then you're going to pay this thing called top-up tax, or what we as accountants call tax at the tail. So that means that 30% is being paid in the company. You now want to take all that money out as a fully franked dividend. You get 30% back as a franking credit. The other 17% you need to pay in your return. So effectively, you're paying 47% on that 100,000 as opposed to 23.5% if it was purchased in a trust.
Okay.
So it's hard to follow for anybody listening, but you've really got to make sure you talk to your accountant and understand the use of the 50% CGT discount. If it's applicable to you, try your very best to obtain it, but not necessarily I suppose you need to understand the other side of the coin is you've got to have the capital there to fund the property in the trust to start with, as opposed to company lending.
Okay, that's a good way. So one of the things I didn't know until I was a business owner and had the cash is you can actually lend money from the business to Steve Palise, the person. So let's just say Palise Property had $1 million profit that I could actually use. So it's sitting there in an account. Obviously, you're going to have the slush fund for paying staff and all that type of stuff. What can I do with that $1 million to buy investment properties? Do you want to explain that process?
Yeah, so there's this concept called secured loan and unsecured loan. So if you draw money out of your company for unsecured purchases like going on holidays and boats and cars and all those other things, you get trapped in this thing called the Division 7A loan. That means you must repay back that money within 7 years to your company with interest, which is assessable by the company and non-deductible by you. So very nasty thing that happens. You're paying tax on essentially money you haven't really earned. If you don't pay the loan back within 7 years, it actually gets treated as an unfranked dividend. It's like a double taxation. Oh, okay. Very nasty. No. What you then do is we say, well,
which I get. They want people not just spending all their profits.
Yeah, they want you to take it as a wage or a dividend, so the government gets a bit of that tax. Now, you can do what they call secured lending. Secured lending is exactly the same way a bank gives you money. Instead of you going to Commonwealth Bank, you're now going to your business. Your business now becomes a bank. It gives you a loan for an asset. Yep. It must be an income generating asset, not your own. Well, people do it on their own home. I don't really like it, but it must be an income generating investment, secured asset. Now, what you've got is you still need to pay interest back to your business, the same way you pay interest to CBA.
But it's going to you.
But it's going to you, and you get to claim the interest as a tax deduction. Must be proper loan terms, must be arm's length distance, must follow all the rules that the ATO provide you. But that is a great way to be able to draw money out of your company under secured loan terms. Again, all arm's length distance, compliant with the ATO. Buy assets and paying interest back to your company, as opposed to paying interest to CBA, who are making billions of dollars of profit every year. So if you haven't heard of that concept, make sure you chat with the accountant. It is common. A lot of high net wealth business owners and individuals do it. Why go borrow from St. George or CBA when I can borrow from my own company? Mm. But this is where people fall down. You must follow the loan contract. Yeah. Like you follow the loan contract with St. George, NAB or CBA, just because it's your own business, you can't float around the lines. It needs to be properly done.
What typical loan terms do you do and interest rates do you see on those loans?
Interest rates are benchmarked by the ATO, and it can be sometimes a Division 7A secured loan, which means it's over 7 years, depending on the asset, and it can be over 25 years or even 30 years. Again, very commercial terms. You just need to know what you're buying, what you're using the money for, and then that will dictate and determine what the loan terms will look like.
Yep. So one of the things I learned, I was like, I don't want to take a loan out of the business because then I'll have to pay it back as Steve Palise, the person. And you were like, no, we can actually do this behind closed doors effectively.
Absolutely.
How do you do that? How does that actually work?
So deed of loan. So in your particular case, if I'm allowed to share it, of course, you bought quite a large investment, shopping centre, and used some of the business money to be able to fund it. A deed of loan was done between the company and the trust, of which there's an interest arrangement in place over a loan term, and that interest is benchmarked again with the ATO and also the Reserve Bank, pegged as a rate. And every year there is an interest repayment that gets made back to Palise Property, which it pays tax on, and the trust gets to claim that as a tax deduction. There's a principal portion as well, so every year that loan's going down to an extent where that property will be paid off. Yeah. And that's coming from the rental income that you're generating. Yeah. So very common in your particular situation, and I'm seeing more and more people now access it as there's more retained earnings in companies.
Because you're effectively just delaying the tax effectively, because now that money goes back into the business, which will then could potentially buy another property, and you're just pushing the envelope down the path.
Correct. It's a really good way to use your capital. Yeah. So it's hard, in life, getting access to capital in very tax incentivized ways is difficult, but that's one of the best ways to do it.
Well, especially for someone like me whose portfolio is generally less than 50% LVR. I don't need the bank's money, so if the cash is there, I might as well generate it in the business.
Absolutely. So your business becomes not only a very successful buyer's agency, but also becomes a bank. Yeah. And that's how it all started.
One of my biggest fears I remember asking at the time was well, what happens if Palise Property blows up and I can't actually, business goes bust or I get sued? I was like, am I going to have to pay that back? And you were kind of like, Generally, no, you can wipe it off, but I imagine there's some more legalities around that.
There's some
I can't
mechanisms.
just do it. It's like liquidate the company and be like, there you go, see you later.
No, the loan that you've given is an asset of the company, but there are some mechanisms there that you can leverage and utilize, especially if you're liquidating. But in your particular case, you've got a very healthy business and you'll be fine for many years to come. But yeah, there's a lot of things in there for people to navigate. It's one of those things you just don't do it off the back of an envelope or a one-pager. It's a proper loan agreement. It's 30, 40, 50, 60 pages long in some cases. Securities and covenants and general security agreements. So there's a lot of things that are getting correctly and properly done to be able to access that money and then also buy some good investments off the back of it.
Okay. Flowing on structures, let's maybe talk about structures in self-managed super funds. So the biggest one that we always get confused about, and even Palise property team members will get confused about this, obviously bare trusts and setup and when to set them up as well. We get accountants being like, oh no, we set that up once you've got the property. I find that just confuses everyone. Do you want to maybe break that down a little bit?
Yeah, so there's one type of structure that you can utilize to borrow and buy property in super. Now, if you're not using any banks and paying cash, you only need a trustee and a super fund to be able to facilitate that purchase. If you are borrowing money, you'll also need a custodian company and what Steve said, which is a bare trust. Now, the bare trust is a very special trust, which is address specific. It's actually in most cases, in all cases, got the loan on there, which is the loan amount, and who the lender is. And these will be requirements by the lender. They want to be noted on the bare trust as a lender and the amount that they've given. Now, generally speaking, the deed gets created when the property is found because it's address specific. On your bare trust, it will have the actual address that you've purchased because that bare trust is linked to that property. And there's some mechanisms behind it that when the property's paid off, it transfers to the super fund, or when the property's sold, it's a simultaneous transfer to the super fund. Super fund reports all the income and expenses. If you set up a bare trust prior to it, it's not really an executed bare trust. All you've done is set up a template because you still need to fill in those couple of things, the address, the lender, and the loan amount. Different states have different rules.
We can still have the name for it effectively.
Yeah, you can still have the name. It's a trust. You can put a name. Generally with my clients, I'll say, look, the bare trust hasn't been established yet, but the name is going to be this.
That's the biggest bottleneck we have. They say, oh, it's not set up yet. And we're like, well, we still need to know. Otherwise, what are we going under contract on?
Yeah, we just put the name. We just say the, XYZ custodian trust. Solicitor that day or the day after will work on it to make sure that it's all done and dated correctly. Different states have very different mechanisms of how you date it. Some states must be done within 2 days of signing the contract. Some states are on the day the contract's signed.
And how you put it on the contract as well.
Correct.
I'll actually attach, you gave us a good, nice little summary of all the different states and how it actually things. So we'll share that with people.
Different. It blows my mind why it's like this, but some states.
It confuses me. And I've done 2,000 acquisitions and I still go to the cheat sheet and go, yep, okay, we're doing it this way.
And it's changed about, especially here in New South Wales, it's changed about 2 or 3 times since, I've been assisting clients with structures and purchasing property in SMSFs. But yeah, each state has a different naming convention. Some states only want the custodian company. Some states want the custodian company as trustee for the bare trust. Some states want the custodian bare trust held on behalf of the trustee for the super fund. You've got literally sometimes 20 names you're putting on a contract. So it's important that you're with the right professionals that know the naming conventions on a state-by-state basis. And with solicitors, there's still so many solicitors that I know today that have no idea on the naming mechanisms and also what a bare trust and how to construct a bare trust.
You've seen it with some of our clients, and they're without bad math, they're clueless. Yep. Like they actually hold up the deal more than anything else, and they think they're the ones protecting the deal. How much does it generally to set up a bare trust? Because as you know, you go under contract with a commercial subject to due diligence. Is this something you're going to be really expensive paying it every time?
Yeah, bare trust will generally range from a fee base, probably the lower point of $800-900. I've seen them quite expensive, go up to $4,000-5,000, which I think is quite excessive. Yeah. But I think for your professional, that range of $800 to $900 plus up to about $1,500-1,600 is probably quite fair.
So reasonably small in the grand scheme of things. If you crash in a deal, you lick your wounds, but it's not.
But most people, the bare trust may has already been established. And what I've seen some solicitors will do is they'll just kind of use it as a template and not charge to, change the names on the next one.
Yeah, okay. Because they've already got it sorted.
They've already got it sorted. Okay. So, for people that are out there, just have a chat with your accountant, your solicitor. They should be able to hopefully negotiate for you a pretty good price. But that $800 to $900 is a pretty minimum, all the way up to say 1,500 as a healthy maximum.
Yeah, all right. This has been a very heavy podcast.
I know.
I think they're going to have to go back and listen to it twice.
We're hitting out all the bangers today.
Let's maybe finish it off with where are you seeing opportunities in the property market at the moment?
So, look, I've done a big podcast on what I've purchased in the last year. For me,
give your podcast a plug right now. We'll do one at the end as well.
Oh no,
we'll do it at the end. We'll do it at the end.
All right. But yeah, for me, the last 12 months, I've been looking. If I'm entering into the residential market, it's been properties with a very big twist. So for development, my portfolio's changed quite a bit. I will make money through residential property via developing. It's quick. It's easy. Again, not for everybody. I shouldn't say quick and easy. It's hard and it's traumatic.
It's quick and hard, but the results are there.
I would say it's hard and traumatic. The more you do it, it becomes quick and easy. Like anything, more you do it, it becomes second nature. So I'll develop through residential. But I've actually bought a couple of commercial properties and kind of followed the strength in the residential side. So commercial for me, I've bought up in the Gold Coast, following the strength in the Gold Coast residential market. And I've probably gone absolutely opposite and bought office space in the southwestern suburbs. Yep. The reason for it is there's just a significant lack of office space, people coming back to the office. So I feel that we're going to have a strength in the lower end of the market as this, potentially 5% deposit scheme comes in, a lot of people getting into the lower end. That's going to filter through to the medium size, the mid end of the market as well. Obviously, we've got some states like Victoria doing very well because a lot of investors are dominating that area. But on the commercial side of things, actually going to think it's counter-cyclical for some of the areas. I actually think Sydney's actually got a very strong run in the commercial sector. I just so everyone know, I'm personally looking for next industrial property, Sydney. Yeah, I just think it's been kind of forgotten about. The yields aren't actually that bad. The yields were bad 2 years ago when you compared it to the likes of Brisbane and Perth, where you could get 6.5%, and Sydney was sitting there at kind of 4.5%, if not 5%. If they're lucky. Now I'm looking at properties for 5%, and I've got the choice now of Sydney, where literally vacancy rates in Sydney is north of 0%. And the rest of Sydney is like 0.2%, 0.3% versus Brisbane, which is 0.5 to 0.7% at the same yield. It's attractive. The hard thing is the entry point is a bit higher. It's more expensive. For something like industrial. You do need a spare couple mil. Yeah, so I think Sydney's just been forgotten about. I like that you mentioned office space. So I normally say, look, office, if you're going big, high density, stay away. It's not your game. But the smaller suburban ones, I had a client a few months ago. We bought in the Sutherland Shire. For his own business, he's like, I just can't, there's nothing available to rent. And his lease was coming up. And I looked at him and went, you're actually right. Like, that's actually a nicely, tightly held area. And like you said, the lifestyle size, people are going back to work, completely different to buying the 22nd floor in the CBD. Absolutely. And those big guys are bleeding. Your big multinational listed REIT companies that are buying all these office spaces in the city, they're kind of having to reshape what they're doing and creating co-working spaces. And I've even heard talks about trying to create them back into residential properties as well, repurposing buildings. Which might happen, or they'll just change the zoning into something else. They'll turn like the 22nd floor into a ballet studio and stuff like that, which we bought one in the Northern Beaches. There was an office building, but the second story was a ballet studio. So it's still office, but why would you not want to go to the gym? If you just press a button on an elevator, who cares if you're going up 2 stories or 10 stories? Absolutely. So I think there'll be more of that kind of in-person retail and what's the word I'm looking for? Experience-based locations. Yeah, that destination retail sector, which is fantastic. But for me, I bought the office space and it was a bit of a weird one. A lot of people going, what the hell are you doing buying office space? But in the end, most people are going back to work. People want that environment again. They want to be next to their co-workers and they want to be close to home. Yeah. So I think having that office space close to where my cohort is important. It gives them a base. Funny you mention that. So even like a Palise property where we used to do we all work remote, and then you actually find like culture dies slowly. You get to the team meetings once a month and they're getting a bit flatter. And then as soon as you do a team day, it all perks up. And I found you generally have to meet up every 2 weeks. If it becomes a month, you can literally see the decline in the team meetings. Do it every 2 weeks, and then we do a team getaway once every 6 months, and we do dinner every month. Like, that keeps culture high. But yeah, everyone actually wants to come in now. We've covered a truckload of information here. It's really heavy. Thank you so much. To get more information, you've actually got your own YouTube/podcast. Do you want to give that a bit of a plug? Yeah, I do. It's called What School Should Have Taught You. It's a bit of my passion project, all about financial literacy. just from things that are quite basic all the way through to what we've discussed today, which is very heavy material.
We kind of went over it in 5 minutes. You do like a bigger, in-depth one, so it's definitely worth checking out.
It's great. It goes through everything you need to know about, even investing in shares and property, structures, things that people get wrong and things that people get right. Lending, what to look at when you're buying. They're all important things that you and I probably take for granted that we know, that we think everybody knows.
I always forget that when I'm doing sales calls. You're just kind of like, oh, I won't say that, they'll know that. And then you say something really basic and like, oh, that's amazing. You're like, okay, maybe people aren't as educated as me, but you forget we've been doing it for 10 plus years.
That's it. When you do it for that long, it's like water off a duck's back. But it's a really good podcast just to give you that really good basic and sophisticated knowledge and financial literacy. But I love today. We've gone very deep into taxes and all these things. It's been fantastic.
But without blowing smoke, like your podcast is really good because you actually planned it as well. It's not like you just sat here and just off the cuff said something. You actually sat there with a whiteboard being like, how do I make this easier to actually explain? And then you've actually recorded it, which is really nice.
Thank you. Appreciate it.
That's right. But as always, Jeremy, thank you so much. I'm sure you'll be on again.
Thank you.
Thank you, mate.
Thanks, Steve. Thank you.
Thanks, guys. All right. Before we wrap this up, I've got a quick update on that Division 296 tax we spent a fair bit of time on earlier. Since we recorded this episode, the government has completely redesigned the proposal. And honestly, this is a much better outcome. Let me hit the key changes. First, they've ditched the unrealised gains tax completely. That was the big problem, the thing that was going to force self-managed super fund property investors to sell assets just to pay the tax on paper gains. Now, it's based on the realised earnings only. So if you've got a property in your self-managed super fund that goes up in value, but you're not selling it, you don't need to pay tax on that growth. You only pay the tax when you actually sell the asset and have the cash to cover the tax bill. That liquidity crisis we talked about, where you might own properties that have appreciated significantly but aren't generating enough rental income to cover tax bills on unrealised gains, that's gone. You can hold your assets without being forced into premature sales. Second, they've introduced 2 tiers instead of 1. The $3 million threshold stays, but now there's also a $10 million threshold. The additional tax is 15% on the amounts between $3 million and $10 million, then 10% on amounts above $10 million. And these rates are apportioned. So if you've got $4 million in super, you're only paying an additional 3.75% on your total earnings, not the full 15%. Third, and this is critical, both thresholds are now indexed to inflation. The $3 million threshold increases in $150,000 increments and the $10 million in $500,000 increments. So that concern about 500,000 younger Australians eventually getting caught by a frozen threshold, that's been addressed. And the start date has been pushed back to July 1st, 2026, with the first assessments based on balances of June 30, 2027. More time to plan and prepare. Now, there's still no draft legislation yet, so we don't know exactly how the realised earnings will be calculated, how franking credits will be treated, or what happens to existing unrealised gains when you eventually sell. The devil's still in the details. But this is unquestionably better. It removes the forced selling pressure, addresses the indexation issue, and creates a much more workable framework for self-managed super fund property investors.